Hey everybody, no Malang, I'm Charlie Moses here with the mochamoguls.com. I'm here with our personal finance expert, Dr. John Beckem. How are you doing today?
I'm doing excellent. How you doing today, Noma?
I'm doing great. So you are on a casual day today, but you just had something that you wanted to share with us, that an experience that you had, and I waited to hear what it is before we recorded. And of course, we're going to draw some personal finance lessons out of it. Is that a correct?
Yes, that's correct. I'm supposed to be on the golf course right about now, but I had some things happen this weekend with a follow-up phone call this morning, and I guess kind of sad, but very hilarious to me, and how institutionalized companies can be and not really keep their pulse or their hand on the big picture, which is always grow your clientele, great customer service, bring in more money for the company. So let's cut to the chase. Let me tell you what happened. So Friday, and this past Friday, I get an email at 5:36 a.m. in the morning, which I'm usually up at 4:30 anyway, telling me that my credit card had been canceled. And it's a Sears credit card. So if you're familiar with the company Sears, I actually had two credit cards through them. It was a Sears regular card and a Sears, they call it Sears Charge Plus, that you would make like larger purchases with if you was purchasing a television, $5,000 or more, and you have a regular Sears card just for everyday purchases. So I immediately, after receiving the email, I logged on, and it said when I logged on, it said that both of my cards had been canceled. So I called Sears and I speak with them. I say, hey, I got this email saying that my cards have been canceled. What is going on? And so they told me due to inactivity, my cards had been canceled. I said, inactivity? I said, well, yeah, I have the cards and I use them as needed. If I need to use them, I would pay them off. But more time, 9 times out of 10, if I go to Sears, I just usually pay cash. But I did not request to have the cards open. I really did not want to have the cards closed because they were cards that I've had since 1994. So we're talking about almost 25 years.
Mm.
So I said, and if you was going to close the card, it seemed like, a courtesy email, letter, or phone call would have been sufficient to let me know, hey, do you want these cards? Or if you do, show some activity or we're going to close them. I get absolutely nothing. And so what it boils down to, they really didn't want to talk to me. They said, you're not utilizing the cards. The last time we see that you utilized the card was over 5 years ago. So therefore, we're not we're going to close it for your safety. And I thought that was hilarious. I said, so if it was my safety, wouldn't it have been safety for you to close it? Maybe, 4 years ago, 3 years ago, why wait 5 years? I said, well, let me put this in perspective. I said, so what you're telling me is since you're not making money off of me, because I have no charges, you cannot, charge finance interest rates to me, and have me pay for them. I said, therefore, I'm not valuable to you. I said, it's unfortunate that you treat. Well, then they stopped me. Well, you could always reapply. I said, why would I reapply if I have a card that's almost 25 years old and you arbitrarily close it? I said, not only that, I said, I'm a customer, at times I've even owned your stock. I said, and so this is how you treat a customer of 25 years. Why would I go back and open a card through you guys when there was nothing wrong with my old card and you guys closed it? So then it tells me, well, there's nothing we can do about it. We're not the department that closed it. Call back on Monday. Today being Monday, I called back and I tried to talk to them, and supposedly the department I was supposed to talk to on Monday when they opened, all of a sudden does not even exist. And so they forwarded me to a manager. Manager, hey, we can do nothing for you. The account is closed. Therefore, you got to start all over. I said, well, as far as what I'm hearing, you work for Sears. She said, yes. I said, do you know that Sears is really on the brink of bankruptcy? And your number one opposition that's gotten you in this predicament is customer service. I said, so here I am telling you that I'm a 25-year customer. I've had your credit card since 94, January of 94. Never had any problems, never had a late payment, never had any type of disputes or disparity at all. I'm an A1 customer, and you just closed my account. And now because I called to discuss it, you don't even want to talk about it. You just brush me off, basically because we're not making any money off of you. And so, I found it to be an oxymoron. If you really think about the irony in this, if you are an individual that's in a lot of debt, if you owe a lot of people, they will be very nice because they want your business. They make money off of you through the interest rate, through the fees, through the services. But if you're a person who are not utilizing these services and you're paying by cash, then it really costs them money to carry you on their books. So therefore, they just want to get rid of you, and they really want to have nothing to do with you. And this goes to show how society is actually backwards. Those who are financially responsible should have advantages that those who are irresponsible do not have. But you kind of see how this is the reverse. And it doesn't really bother me. I wasn't utilizing the card. What was nice is that by having a card that's 25 years or older, your FICO score, which is your credit score, actually increases because you have longevity of having responsible financial behaviors. And so that was the only reason why I even had the card and kept it at all these years. You never want to close a card yourself. It's okay if the credit card company closes the card, but if you close the card, that's actually a ding against your credit. If the credit card company closes the card, then nothing happens other than you just loses that longevity. After 7 years, that payment history will actually fall off all of your credit report altogether. So I thought that was hilarious since, I'm discussing personal finance with an audience to say, hey, things even happen to me, and I'm the expert in this field, and what can we learn, and what are the reasons why things happen? I think that's more important to understand why they happen. What is the schools of thoughts, both pro and con, that are for that, and what's going on. So that's it.
So I had a couple of questions, and you kind of answered one already. When you said I wrote 25 years of credit. So my follow-up question was going to be, what's the benefit of 25 years of credit? And you obviously said that it increases your FICO score. So does that mean that now they've affected your FICO score negatively?
Actually, I don't think so. It is just to show a closed account, and like I said, it'd be closed by the creditor, which is them. So it's not going to affect my credit score. My credit score is A1 excellent. So the only thing that's really going to affect my credit score is a derogatory, something that's derogative, late payments or anything of that nature. Those things really doesn't affect my credit score. I am a cash buyer, a cash payer. So you always want to have at least something that shows a continuance of payments for those who need the credit to expand, things of that nature. If you really don't, it don't matter. But I got years and years of excellent credit that's already established. And 25 years is the threshold that shows a longevity. So 25 years give you into that excellent standpoint under the umbrella of longevity. So the FICO score has many different things. It has utilization, how much credit do you have at your disposal. It talks about payment history. Age of length is the one I'm talking about. So that's just one tangent or one aspect that goes into your overall score. And so you kind of move from, good to better to best. So 25 years or more gives you into that best, excellent aspect of that one umbrella. Okay. But if you got a card that's 10 years or more, you're still in the good area. If you got new cards, then that's when you would fall into that, until you establish at least a year or two. Good, not great, but it's still good.
So then the other thing is, you said you never want to close your own card, which I'm guilty of, because I remember we did another segment where we're talking about, establishing and building credit scores. And one of the things that I did was I paid stuff off and then I closed it. And you'll tell me, which is better. I personally felt it was better to close them to remove any temptation to start it all over again and end up in my eyeballs in debt again. Because I got these cards when I was in college, and the level of discipline at the time was not very high. And then they got out of control. And I felt so proud of myself that I, got it all paid off and got rid of it. but you're saying it's not a good idea to actually close your own credit cards, right? But the caveat, could it be that if you feel like you're going to make a mess out of it, it is actually better to just put it away and leave it alone?
Right. Right. And so there are different variations, right? So for someone, as you explained and alluded to, if you already have some problems, you're problematic, in making charges and things of that nature, then you have one or two choices. Either you can cut the card up, so the account is still there, but it's cut up, you don't have access to it. As long as you don't go into the store and say, "Hey, I lost my card," X, Y,
Give me
Z.
another one.
Uh,
Right, yes.
or you can close it. It depends on what is going to be your immediate and long-term goals in regards to credit. If you're going to buy a house and you're not going to pay cash for it, and you need to have some type of credit established so they can see a payment history, so that you can get a lower interest rate and better terms, then it might be beneficial to you to say, hey, either I'm going to cut these cards up, put them in a safe deposit box, because then it takes time to go get the card, and hopefully by then you come to your senses and say, hey, I don't need this. Or if you say, hey, I'm already established. I have a home that's paid for. I pay cash for my cars, things of that nature. And if I really need to buy something online or hotel, I have a debit card that has a MasterCard or Visa logo, then your situation is different. You can say, I'm going to close it. But for a lot of people, so for the majority of people that probably this video is speaking to, you might be in a situation where you say, well, I want to keep the card there to show some type of history, but I don't want access to it. And so therefore you might, like I said, cut it up or put it away where you don't have immediate access. And yes, so it does affect the credit score. So if you close your account, then I believe the credit card companies are saying, wait a minute, maybe she's having some financial problems. She don't trust herself. So therefore we shouldn't trust her, right? And they start to affect your credit that way. If a company just arbitrarily closes your account, maybe, and that could be for a number of reasons: suspected fraud, loss of card, or in my case, due to inactivity, then it's not a ding against you. It pretty much stays status quo.
Okay, that makes sense.
Yes.
And at 20, I personally don't think credit cards are a good idea. Now at 40-ish, maybe.
And also, I highly recommend. So if a person have not established a credit, don't have what I call department store credit, you really only need 3 cards. If you want to maintain credit, I have other credit cards such as MasterCard, Visa, whatever, that I do put charges on, but I pay them off before the end of the month, so I don't see any interest charges. But for me, it's just easy. I don't have to carry large sums of cash. I could just pay for something with my credit card and then, send them a ACH, which is automatic check-in withdrawal, paid directly to the credit card before my cycle ends, and I don't pay interest. But you really only need a Visa, a MasterCard, and or an American Express. I think Visa will be your number 1 card because it's accepted everywhere. No matter if anyone does any type of exchange as far as companies, they all accept Visa. The second highly accepted is going to be MasterCard. They're going to be number 2. American Express, a lot of people do not accept American Express. There's a lot that do, but there's also a number of people who do not, because American Express, which they all do, they all charge the company. So if you go into Home Depot, as an example, and you use your credit card, that credit card company, whether it's Visa, MasterCard, or American Express, charges a fee to Home Depot to process that card. That's how they're able to, in turn, give you money back, right? They say 5% cash back, or they give you these points to go towards airlines. They're not doing it out of the kindness of their hearts. So if they charge, in my example, Home Depot 2.5% to process this fee, they give you 5% back, because them giving you 5% rewards the behavior that they want. They want you to continue to use the card, because and the delta or the gap between, they charging them 2.5, giving you a 0.5 back, they're still making 2%. So the more they reward you, the more you actually go out and use the card. And so because there are different variations of fees between what the company or institution pays, between Visa, MasterCard, American Express. American Express historically have always been the most expensive. So that's why you go into a place, a lot of times they want to accept American Express, but everyone accept Visa and MasterCard. And so for those who want to establish or maintain credit, or even for emergencies, then you really don't need department stores. You don't need the Macy's, the Sears, the Home Depot, so forth. If you got a Visa, MasterCard, and American Express, you should be more than covered for any type of things that you want to charge.
But and you can correct me if I'm wrong, but the department stores are usually the low-hanging fruit.
Yeah, they're the low-hanging fruit. So why? So in everything, you got to look at what's the pros and cons to this. Mm-hmm. So you go into a department store, which usually have a more lax credit requirement. In other words, it's easier for you to obtain that credit card. Why? Well, they cipher you in by saying, well, if you at this store, if you open up a charge card, we'll give you 10% off your total purchase, this one time. Mm-hmm. So they get you by that hook, you save 10%. Number two, the department stores usually have the highest interest rate, APR, annual percentage interest, that you're going to pay a year. So if your MasterCard or Visa might be at 9.9, 10%, your department card might be 21, 28, 29, 32%. Mm-hmm. Also, it encourages you to continually come in to utilize that store, right? So if you went to Macy's and you got a Macy's charge card, well, not only are they going to charge you, let's say 30-some%, but now you're going to continuously come back and keep utilizing that store. So instead of going to JCPenney's to buy something, I got a Macy's charge card. So I just go to Macy's. I don't have to worry about it. I can charge up to the wazoo and pay this small monthly fee. When actuality, just say $1,000, it could take you over 10 years to pay back $1,000, paying the minimum balance every single month.
Yes, I have personal experience with that, and they don't just encourage you to come back by you having that card. They also bombard you with emails and coupons, yes, and everything they can do to just keep you coming.
So, yeah, sales, discounts off of this if you utilize your card. Yeah. Charge card days, when anybody who put it on their charge card receives additional 5%. Yeah. And so you see, it goes back to my point of why Sears canceled my charge card. It's advantageous for them as an institution, a company, if you're utilizing their money. I call it renting their money, because they can charge you, a high interest rate. They can keep you coming. It's kind of like it's an addiction. They're feeding your addiction. But if you are a disciplined person, you have no need for them, then how you can be treated and or regarded can be somewhat different.
Yep, lesson learned. So thank you for sharing your experience, and thank you for sharing your lesson. There are more segments like this coming, of course, in the Ask Dr. John Beckem series. I just want to remind everybody that they can find you at drjohnbeckem.com, drjohnbeckem.com, or at personalfinanceblueprint.com, where you have a blog that you share information like this that I personally have found very useful, and I think everybody else will as well. So
yeah, and just one more note I forgot to add, which is very important. Yes. On that higher interest rate on your credit card, that interest is compounded daily. So yes, it's not like a car loan or a mortgage where it can be every 15 days for some car loans, every 30 days for a mortgage. This is compounding interest daily.
This is when we're talking about departments.
Yeah. Well, most credit cards in general. So you can see where it's very advantageous for that credit card company to go out and have people utilize fictitious dollars, right? They're not even giving you cash. It's something, it's digits that's put up on a computer. It was a way to keep the economy growing and keep people buying. So where economy can be constricting or becoming smaller, it looks for ways to sustain itself and grow. In years past, we did this through manufacturing. You manufactured a product and then you sold it. You sold it domestically as well as overseas. That in turn gave the company dollars. Those dollars from the companies passed down to the workers. The workers go out and they purchase goods and services, which means that more businesses, small businesses are open, more small businesses expand, which grows the economy. And so what happened was you start to see a mass exodus of manufacturing moved overseas. Lower wages, not as many restrictions as far as environmental. And so therefore, how do you grow the economy? Well, the banks came along and said, well, we got a great idea. Let's just extend credit, right? So if you look at you manufacture something, it was sold, that company took the proceeds, gave it to the employee went and bought goods and services. If you minus that, if we just put this debt out there, then you're able still to go buy goods and services. Mm-hmm. And it's something that they just made. And it grew the economy. And so if you look at, and I know we're kind of getting a little bit further, but this is a good point. Mm-hmm. If you look at today is 2017, that the stock market is growing. Just last week, the Dow hit over 23,000 for the very first time. And you say, how is this happening, right? It's debt. Because if I look at the price earning of a company, it has not changed. So we don't see where the value of a company is increasing, but we see the stock price is steadily increasing. We see that the consumer spending is steady increasing. We see that consumers are going out getting more and more mortgages or homes or refinancing. How is this happening if you're not manufacturing anything more, right? Mm-hmm. It's through the creation of debt.
So we're all in bondage, or at least those who are participating that way.
Yeah, and it creates a bubble. And so, I have a prediction that in 2018, we're going to see a drastic change in the stock market, not for the better, but actually for the worse. And what happens then? So everything that's supported by debt, people even use one debt to pay off another debt, right? Mm-hmm. So you see credit cards, pay off another credit card and we won't charge you interest for 6 months, a year, right? So you basically just shifting debt to debt. And you robbing Peter to pay Paul. But there's not a true creation of new wealth or new currency. And so therefore, you only can keep this cycle going so long before it all comes crumbling down, because that house is built on straw and not bricks.
Right. And I have a very big question, which we'll discuss in another segment, of really how to insulate yourself.
Okay, great question.
From what I am not a finance expert by any stretch of the imagination. But even I had the idea that, okay, what's going on? The trend that I'm seeing, it's going to crumble. Eventually, it's going to crumble.
Yeah. What's the difference in 2017 versus 2007, 2006? Tell me what's the difference that you see.
There is none.
Absolutely.
There is none. And that's how I was able to see it. I've been alive long enough to have seen that, okay, when these things start happening, then this happens, and then this happens, and this happens. So I'm able to see, I've been in the job market long enough to see, or been an adult long enough to see, when people start feeling squeezed, you start seeing jobs, there's certain things that you can just kind of start to see happening, and then think, okay, the last time I saw this, the economy crashed. So you can start to say that even without being an expert, just by being observant and being able to recognize patterns. So I think that's a great video.
Yeah, let's do that as a follow-up, because we have what happens when the market is climbing like it is doing now, currently doing. You will start to see an influx of non-experts but spectators trying to ride the high, right? And then getting in on the tail end. And what sequential impact does that have? And how can you, as you said, insulate yourself? What should you be aware of? How can I prepare for that? So we'll see you in the next video.
Thank you, everybody. And thank you, Dr. Beckem. We will see you in the next segment. Take care, guys. Bye.